Today we'll be looking at interest zone, and from the word interest zone, it means that the zone that I desire to see or that I'm having interest for. So previously we have looked at market structure, and I explained that anytime you open your chart to analyze trade, the first thing you need to look out for is the trend of the market. Like, this is a line explanation of it. So when you confirm that the trend of the market is bullish, you already know that you are looking for buy opportunity. One of the major rules of trading is that don't trade against the trend, right? Unless maybe you are a guru. Now, because it is bullish, we are looking for opportunity to buy. So the second thing you are going to identify is your RSR. So if you do not know what is RSR, go and watch the video on reaction swing range. It explains it well. So your RSR is your recent higher highs and your recent higher low for bullish. Then after identifying that, we are to locate our supply and demand. Now, this supply and demand is our interest zone, but there are things we are going to look out for here, and that is what I want to explain in this course. Now, this is bearish. The trend of this market is bearish. The market is moving in downward direction, forming lower high and lower low. You can see that presently this is lower low, the recent lower low, while this is the recent lower high. Now, what are you going to do after identifying the trend? So the RSR here is the recent lower high and lower low. So after confirming that, we have to identify our supply zone. For bullish, this is demand zone, where there is much of buyers pressure, so that they will gain in control again and push the market in upward direction. Why this is called supply zone. This is where seller will gain more momentum to control the market in their own direction. So what is interest zone? Interest zone is a predefined price area. Can you see? Predefined price area where a trader expects a high probability of buying and or selling activities based on the market structure. Notice, based on the market structure. It is the market structure that will determine what you want to do in the market. It's the information that you derive from the market structure on higher time frame that will tell you, okay, this is where the supply zone is, this is where the demand zone is. And I said our supply and demand zone are interest zone, right? Supply and demand, liquidity, or other technical confluences. Instead of entering a trade at any price, trader patiently wait for price to reach an interest zone. See, when it comes to forex trading, one of the keys that you need to have is patience, right? You just need to wait. You need to wait for price to get to your interest zone before you start looking for opportunity to trade. The moment you cannot wait, you have signed up a contract to be playing your account. That is just the bitter truth. If you are buying at supply, you are doing yourself more harm. If you are selling at demand, you are doing yourself more harm. If you are buying at supply, you are doing yourself harm. So just wait for the price to get to your interest zone before you look for opportunity to trade. But note this, interest zone does not guarantee that price will reverse or continue. Instead, it highlights an area where traders should closely monitor price action and wait for confirmation. That is another thing. The price will first get to your interest zone, but that it gets to your interest zone does not mean that it will respect what you have in your mind. Since we know that, okay, bullish trend, you are looking for buy, so the price is now presently at demand zone. It does not mean that the moment it gets to this demand zone, it will push to buy direction. It's possible that the price will break the demand zone and move in an opposite direction. Do you get the point now? So what you need as a forex trader is that you should be patient. When you are patient, you don't have problem again. And I decided to make this strategy simple so that it will be easy for every one of you to easily analyze trade, right? As from next week, we are going to be analyzing different charts on our weekly session. Then you have to make use of this strategy, right, to analyze your trade. And you guys will see that it will be very, very easy for you to do. So let's proceed. Now, before I explain what I want to explain, let me just talk briefly on candles. This is bull, while this is bear. This is buyer candle, this is seller candle, right? I just want you to have a basic knowledge about it. If market want to open for buy, it will open here, right, and move like this. Sorry, it will open here, move like this to the low, then move up to the high. This is the high, then close here. Now note this gap here, right, is called shadow. This line is called shadow or wick. This is called shadow or wick. For bear candle, the price will open here, move to the high, right, come down to the low. After getting to the low, it will now move and close here. So what is constant between both of them is the high and low, high and low. This is high and low. But for buy will open at low area and closed at high area. While sell, it will open at high area and close at down area. Now the reason I'm showing you this is that when you see candle, you should be able to know the movement on lower time frame. Let me use this as a sample. This is a candle, right? Let's say that this is a bullish candle, right? Why this is a bearish candle, and I see this candle on higher time frame. Do you know, from seeing this candle, I know what is happening at lower time frame? So look at this. Let me just draw a line like this. So sometimes I don't need to go to 15 minutes. I already know what is going on in 15 minutes. So you can see, this is the eye. I believe you get that. Why this is the eye of the sell direction, the sell candle. Now I said this is sell candle, bearish, while this one is buyer candle on 4 hours. So you know that for buy, price will open here, right? Price open here, and that is also the low of that candle. It's push up, right? Go up like this. This is the eye, then come like this and close. It's close here. Do you get? That is the close. But for sell candle will open here, move to high, then close downward. So this is where the sell candle open. So the sell candle open at the close of the buy. So this is it. What happened? It moved to the high. So Can you see? And sweep this level, sweep, liquidity sweep, or some people will be expecting double top, then it moves downward, downward, downward. This is the low of a buy, break that low of high and come here and form a low here. Can you see? So if you go to lower time frame, this is what you are going to see. Double top, or this one is liquidity sweep, then price push down. That means when you see candle on higher time frame, you already know what is happening on 50 lower time frame. I believe you get that. So let's proceed. Imbalance. You know, I said earlier that interest zone is our supply and demand. But what makes our supply zone and the demand zone valid or relevant, the reason why we can even be looking at it is because there is imbalance. There is imbalance. Like, let me show you again. Like this demand zone, this is supply zone now. There must be imbalance around here. Imbalance is momentum. So we must see it. We must see imbalance around this level before we can say this is a valid demand zone or interest zone that I'll be looking at. This is a valid supply zone that I'll be looking at. So let's proceed. What is imbalance? Before I proceed, let me just give this general example that I used to give. Now, this is a marketplace, right? It's not making sense that you go to markets and you see only buyers and sellers are not coming. If sellers are not coming, you can't call it a market yet. Just see this as a market, right? Then you see, you go to this market and the only person you see, the only people you see are buyers, right? No seller. You can't call it a market. You can't call it a market. The reason why you can call it a market is when you see both buyers and seller. It is both buyers and seller that makes up a market. Transaction must be ongoing. So maybe here now you now see only seller also, no buyer. So they will just be there. They will not make any profit because they are only sellers, no buyers. So in forex trading, this is what we call imbalance. So sellers must come to this location and make transaction. The same thing, buyers must come to these locations so that we can call it a market. A market, right? Okay, see this bullish candle 1, bullish candle 2, bullish candle 3. You can see the high of this candle, of candle 1. You can see the low of candle 3. Let me write it out. And 1. So the high and the low of the third candle, they are not touching each other. So there is a gap here. That is what we call imbalance. And this imbalance always acts like magnets. If price push up, it will still attract price back to come and fill the order that is available here. So when it mitigates this level, we can now start looking for opportunity to buy. The same thing is applicable here. This is what we call, this is candle A, right? Candle B, candle C. This is for bearish. This one is bullish imbalance, meaning that it's only buyers that are in control. So they need seller to come and complete it so that we can call it market. The same thing is applicable here. This is bearish imbalance. So you can see that the low of this first one is not touching the high of this third candle. So this is what we call imbalance, or another name for it is fair value gap. Fair value gap. So we are expecting buyers to come and balance that equation. Then the market will push it down. So when you spot imbalance and in the chart or before a breakout, that level, the zone at that level is valid. the zone at that level is valid. So majorly, anytime you want to analyze trade, when you see breakout, look out for imbalance before you start doing anything. Look at this. You can see that the high and the low of this it touch. So that place has been filled, is balanced. You can see the high and the low of this place is filled. It's already balanced. When you see a breakout with imbalance and a breakout without imbalance, let me use this. When you see a breakout, this is a breakout BOS. When you see a breakout with imbalance, this is what will happen. The price will come, right, and fill that level and likely to push up. Note, is an interest zone, and I said that is an interest zone does not mean that it will respect your direction, but most of the time it will respect if you look out for confirmation. Now for this, the price will come here and fill that level, then push down. But this is a breakout and there is no imbalance here. There's high tendency that this price will come back, right, and sweep. Note, and sweep this level before pushing up. So just have this knowledge that most of the time where there is balance before breakout, there's high tendency that there will be liquidity sweep coming back to form around these regions. It will come and sweep that level. I will show you guys the chart example of that. So just know it. Breakout with imbalance, breakout without imbalance, breakout with imbalance, price will reverse back to that level before pushing the direction we desire. But without imbalance, liquidity sweep may be formed. Now look at this. This is imbalance. Can you see? And forget about the color. This can be blue, this can be green, this one can be red. So you can see there is a gap at this level. This is imbalance. We are expecting price to come and mitigate that level. See what happened. The price came and touched this level. But see, this also leads to a breakout. This is a breakout. This is a breakout. This is also a breakout. So I know from what I'm seeing here, I know that this market will come back and sweep this level. Right? After sweeping it, it can decide to move up and it can decide to go down. Something like that. So let's see what's happening. You just need to understand the way the markets behave, right? So and these are the basic things that you need to know anytime you are trading. There's no need for you to complicate it. Keep it simple, right? Look at this. Can you see? This is liquidity sweep. Now this price will now push up. But that it sweep this level does not always mean that it will push up. It can just come like this, form a reversal like this and push down. So have it in mind, right? But this place is our confirmation. Then we'll be looking for opportunity to buy, right? After sweeping, the price push up and form another breakout of structure, right? Break this level, and you can see there's a gap here. So we are expecting this price to still come and push up. So that is just the basic thing that you need to know about imbalance. So let's move to order block. Order block is the last bullish candle you can see before a strong bearish move, or the last bearish candle before a strong bullish move, where institutional traders are believed to have placed significant buy or sell order. When price returns to an order block, it often acts as a key area of support or supply or demand, right? creating high probability opportunity for the market reversal or continuation. See, this order block now is what we call supply zone, and it is our interest zone. So there's no need for you to be say, okay, I'm looking for supply zone or demand zone or order block. You can say, okay, you can just say this is my interest zone, and you say, okay, this is my order block. You are still saying the same thing. But the main thing about order block is that order block must have imbalance. That is where you can say it is valid. So this is a valid order block, is a valid demand zone, is a valid interest zone. So personally, when I export this on daily time frame, right, where for bullish trend, let me go back here. Let me show you something. Okay, now this place now, you can see for bullish trend, I'm expecting to see a order block here, but this order block must have imbalance. And I say imbalance is like a magnet. So after identifying my RSR, I will check, is there imbalance? So I will identify that order block and that's imbalance. I believe that when the price gets to that level of order block, there's high tendency that it can push up, but you will go to lower time frame for confirmation before you place your trade. So let's proceed. Okay, this one is for the bearish order block. You can see this is a blue candle, and I say it does not matter, maybe it's blue or red. Can you see this red? But you see there is an order imbalance here. There is a gap, there is imbalance. Because of this imbalance, that is why we know that this is a valid order block. This is a valid order block. So that is that for today. Next week we are going to apply all these parameters. We have looked at market structure, we have looked at RSR, we have looked at liquidity, and today we looked at interest zone. So next week we are going to combine everything together and use it to analyze our trade to determine where we are going to place our trade. So we already know that anytime we want to trade, we are waiting for price to get to order block, right? A valid order block is a block that have imbalance, and an order block can be our supply zone and our demand zone. So I will advise you guys to watch all the video again and again until your mind is saturated with all the parameters. You can easily spot it out in the market. But note, as a forex trader, you must be patient. You must be able to wait patiently for the price to get to your zone before you do anything. So I will see you guys in the next class. Take care.